we're 13, 14, 15 months into this real tech bear market where a lot of those smaller speculative names and a lot of these SPACs are the ones that took a majority of the damage. And then only until November did it start to infect the rest of the market. And then really only in the last 4 or 5 weeks have we seen that kind of move up to the larger cap names. And in a lot of ways, if we are in a bottoming process, which we think we are, we'll look back in a lot of ways, this will be kind of a textbook kind of bear market the way it plays out. As for the SPACs, obviously we saw a lot of companies come public last year that really had only not much more than a business plan. But through that mix, there were actually a few companies that we think are legitimate long-term buys here.
Okay, which ones are those, Ryan? And how do you determine which ones are from that SPAC wreckage?
There's a handful, two that stand out. Probably the largest is Cvent. This was a company that we owned back in 2015-16, was acquired, taken private by Vista. They came out in a SPAC format last year. You may ask, for a company that's that mature, they lead the event management space and technology. They were hurt, obviously, during COVID. There weren't a lot of live events. They had to transition to a hybrid model for the events that they were hosting, and then a virtual model. And the results were so poor, they really didn't have that traditional IPO route to go. They had to give these longer forecasts that were allowed during SPACs to show people as the economy went back to normal that their results, should benefit. And we're starting to see that already.
Ryan, the Elon Musk Twitter process has been confusing to a lot of people, but you've been pretty nimble in managing it so far in this process. Talk about what your playbook's been.
Well, Twitter's been a large position for us for a while. We've always felt that it's been underappreciated and undervalued, given their global reach as a social media company. Obviously, they've been unsuccessful in kind of figuring out exactly how to monetize the subscriber base well. And so then when Elon Musk made the investment, we thought that was an interesting move. And then when we did think that there was a decent chance he would end up trying to acquire the company. And then once that happened, the stock went over $50. We basically felt the risk reward wasn't that positive, given there could be some bumps along the way. And quite frankly, also because we saw some, looking as an opportunity to redeploy. I think now that the stock is back into the mid-30s, it's really, at this point, the risk reward is skewing the other way. We still have a little Twitter position. We're actually considering adding to it. We do think the deal will eventually go through, even if it comes in at a smaller discount to the 54.20.
Right, but you're not betting on a drawn-out legal process.
There could be. But we're talking months, not years. So, it's still, this is going to be, in essence, an all-cash deal. We would expect a fairly quick close once, we get through some of these legal issues. It's always a possibility. I think it's well more than discounted in where the stock is today. I'm not sure the stock would fall a whole lot from current levels, maybe another 10 or 20%, even if Elon were to walk away.
Ryan, when you look at some of the more beaten down speculative, smaller mid-cap names, do you like them because you think that they might be able to get close to or reach previous peaks, or do you think that they're attractive as M&A targets?
Really both, but when you look at the larger cap names and why we're focusing, and we have the lowest exposure in our history right now to large cap tech. The big reason why small and medium cap tech looks interesting to us here is we do expect interest rates to rise. We've gone through this period of really, at least 12 years of relentlessly lower interest rates, which has boosted all of large cap tech and boosted multiples. They're the ones most at risk to seeing that compression. The small mid cap type of names that we favor, they're growing 20, 30, 40% a year. They're not going to be as affected by interest rates. So I think when a lot of people look at higher interest rates being bad for all growth stocks, longer date, and looking at it in terms of being longer dated assets, I think they're missing the vast difference between the large and mega cap part of the tech market and the small and mid cap space.
Are you talking about profitable growth tech then, Ryan? Give us some names here.
Yeah, well, it's, some of the names you mentioned we've been adding to, like a Square or a Twilio. They're probably more in the mid-cap at this point, but, valuations have come down tremendously here. And these are companies that are extremely well-positioned, continue to gain market share. these are next generation technologies that obviously got a boost during the COVID period, but are still, even coming out of COVID, still able to put up 20, 30, 40% type growth. And, to expect to get these companies at, maybe they shouldn't be at 15 or 20 times revenue, but we would argue they shouldn't be at 3 or 4 times revenue either in the case of a Twilio.
Ryan Jacob, thanks for being with us today. Talk to you again soon.
Thank you.